John, it's really good to see you. Today, we're talking about 3 RMD strategies to reduce your tax burden. I know that you're always thinking of strategies to help your clients reduce their taxes. So let's talk about those required minimum distributions because proper planning is vitally important. And let's start at the top. What are RMDs and how are they calculated?
Required minimum distributions are way that the government says, hey, we let you defer your income while you were working,
Hmm.
and you didn't have to pay tax at that point. When you reach 72, the government starts to talk and say, hey, when you it's time to start taking some of those draws now that you're in retirement, and those required minimum distributions are how they do that.
Hmm. And you want to touch it all here on the formula, how they figured that out?
Yeah, to make it a little more simple, I mean, obviously we look at equations, but long and short is they look at your total IRA and 401k balances.
Hmm.
They divide it by the number of years that they expect you to live, and that is your required minimum distribution.
Hmm. So I know also that you work really hard to make sure that your clients take those distributions when they need to, because if you don't, there is a very significant penalty.
It is. If you had to say you had to take $10,000 out of your required for your required minimum distribution, and you did not take it, the government is going to penalize you 50%. So that
Ouch.
means they're going to take $5,000, but then you're also going to get taxed on that $5,000 of that penalty.
That one hurts. I'm glad that you're on top of that.
Yeah,
So
don't want to
now
miss
let's
that
run
one.
through the 3 strategies to reduce the tax burden that comes with those RMDs. And the first consideration here is taking those distributions as early as possible. Why is that?
Some people, and again, the main topic of these three goals is to make sure that these goals fit what you're trying to accomplish in your
Right.
life. And so these are all strategies that need to be tailored to the individual person.
Right.
So, one of the ways that we're able to reduce that is by some people who aren't taking their Social Security yet, and maybe they don't have much of an income and they're living off of modest means. Maybe they start drawing that at age 59 and a half and having a low tax burden at that point.
Okay. And next on the list of considerations, something that we've talked about many times this year, John, Roth conversions.
Roth conversions are a hot topic. They've been around for a
Yeah.
long time. In fact, I worked with my father, and I remember him telling me at one point the government actually allowed somebody to pay their taxes on their IRAs over a 5 year period.
Mhm.
And when they did that, it created a tax free benefit for the person drawing out. And it also eliminated any required minimum distributions down the road.
Mhm.
Um, that's not the way it is today. Today, the Roth conversion is where you want to look at your current tax bracket. You want to see what sometimes the income and the amount that you have to take out along the way. Do you have a pension coming in? So there's a lot of things that go into the Roth conversion. But really, the biggest thing for the Roth conversion, in my opinion, is more for that next generation. Is you're creating a tax-free benefit to go to them in the future.
I see. That makes sense. All right, John, let's talk about our third consideration here, and that is a qualified charitable distribution. I like these because they really come out to be a win-win for everyone. What are they?
They do. It's a way of saying, hey, you know what? I don't need my required minimum distribution this year. And a lot of people fall in that. A lot of people maybe live off their Social Security, or maybe they have a lot of money in their checking and savings accounts,
Hmm.
and they just don't need it. So there's a way of saying, hey, I don't want this required minimum distribution. And instead of it going to you, you direct it to your charity. Maybe it's your church, or maybe it's a cause that's important to you. And a lot of people have really taken advantage of this. This is actually even more popular now since the tax codes were changed a few years back.
All right, so I think that just to kind of underscore the reason that we're doing this video is this all comes down to strategic tax planning, right? And RMDs are income, which also goes back to a common misconception that you'll be in a lower tax bracket when you retire, but that's not always the case.
Absolutely. And just kind of going back to the Roth conversion again, that Roth conversion is kind of a hot topic because it's easy to as an advisor to come and say, hey, I want to create some tax-free income for you. That's exciting sometimes to hear, but a lot of times it's maybe over promoted. I've seen models where it works both ways. I've seen where someone were to not convert, and then they invest the amount of money that they would have had to pay in taxes instead. And there's models that show that perhaps at the end of a time period that maybe they have more money there. And also a little bit less desirable reason to do it is that the government now makes the beneficiaries draw that Roth conversion out over 10 years instead of their whole lifetime, which was a big change a few years back.
Right, right. What I'm hearing from you, John, is that these are all great considerations, but of course, there is no cookie cutter answer for everyone. So it would certainly benefit to talk it through with you or another expert. Probably the earlier, the better. So if somebody has any questions, what's the best way to reach you?
Yeah, you can reach us at our phone number. It's 440-471-4300. Give us a call and we'll be happy to go over that. But like I said, it's very important to have a plan ahead of time for those required distributions. So that way they work in your favor and make sure you don't get caught maybe in a higher tax bracket down the road.
Right. Such an important consideration. John, thank you so much.
Thank you. Appreciate it.